Today we're going to discuss the capital stack, specifically how the capital stack relates to real estate and financing real estate projects or deals. The capital stack refers to the structure, sources, and allocation of funds in a development deal, or really in any real estate acquisition. As in a corporate balance sheet, funds can be classified as liabilities, which are loans or anything that you borrow and have to pay back, or as equity, the money contributed by owners or investors. Traditionally, prior to the mid-1980s, first loans or mortgage loans comprised about 80% of real estate financing. The remaining 20% was contributed through owner's equity. However, as the financial markets have continued to mature and banks have become more risk averse, other financial products were created to fill the capital stack. However, these new funding vehicles could ultimately be classified as either debt or equity. We're going to take a look at two of these products in a little more detail. In order to promote growth, investors and financial institutions created a product that would minimize or lessen the out-of-pocket cash or equity needed to undertake a project. This new product was called mezzanine debt. Mezzanine debt was started in the 1980s and has been around and in use for approximately 30 years. Now, for those of you that don't know, a mezzanine is a low story between two others in a building, usually between the ground and first floor. As such, mezzanine debt gets its name because it is the layer of financing that lies between a company's senior debt or mortgage loan and owner's equity, filling a gap between the two. Mezzanine debt, like first lien or mortgage debt, will need to be repaid. And this increase in leverage or borrowing made projects more risky. But they increased return on investment because it lowered the equity required that owners needed to contribute to a project. The second product we're going to look at is another investment vehicle that's relatively new and is called preferred equity. Preferred equity has grown in popularity over the last 10 years. Like mezzanine debt, preferred equity sits between owner's equity and your first lien or mortgage debt. Moving forward, to differentiate between preferred and owner's equity, we're going to refer to owner's equity now as common equity. Now, taking a look at the capital stack, preferred equity sits above mezzanine debt, but below common equity. And as you look at the percentages, the percentage of owner's equity has decreased. The percent of mezz debt borrowed has decreased, but also the percent of first lien debt has also decreased. Preferred equity differs from common equity by the preference in cash flow distribution, i.e., before owners receive a penny of project distributions, not only does their loans need to be paid back, but their preferred equity investors need to be paid back a predetermined rate of return, often referred to as the preferred return. It is only after this benchmark return is distributed do owners receive any cash flow distributions from an investment. As you've seen, there are different buckets of capital that go into financing a real estate project. These different buckets receive cash flows in differentiating orders. and the order which the cash is distributed is referred to as the waterfall distribution. In relation to the capital stack diagram, the order in which participants receive their cash flows runs from the bottom up, meaning your first loan needs to be paid off before your mezz debt, before your preferred equity gets their return, and before common equity is paid out or common equity returns are paid out. However, as you move up in position of the capital stack, much like developing a skyscraper, the higher you go, the more risky or the more risk you are undertaking. So the higher you move up in the capital stack, the greater the risk of non-payment. In order to bear this increased risk, the returns need to be greater for each succeeding bucket in the capital stack. First lien debt usually carries a rate of between 4 and 6% in today's market. As you move up, mezzanine debt usually charges between 6 and 8%, and preferred returns on equity normally sit between 8 and 12%. Common equity, because it is the most at-risk capital, requires the greatest return. Usually investors look for an 18% rate of return as a baseline hurdle for an investment, and usually prefer to invest in deals that have internal rates of return, or IRRs, in the 20s. Now, for those of you interested in learning more on this topic, I suggest that you subscribe to the Real Deal YouTube site. On this site, there is a short video describing how New York condo towers are being financed. You can access this video by going to YouTube, searching for the Real Deal channel, and either subscribing or playing the video. Otherwise, you could type this link into your browser. I hope everyone has a better understanding of how to finance a real estate project and how those buckets of financing fit together in what's referred to as the capital stack.